Hey, so for the last few weeks, you were told the market was standing on a solid foundation. You were told that any weakness was just an underbelly, a minor issue. And guess what? That foundation just broke. It wasn't a crack, it was a catastrophic failure caused by two specific shocks that hit almost simultaneously. And understanding them is the only thing that matters for your portfolio right now. Look, if you only have a minute, here is the single most important takeaway from all of this. The reason for an interest rate cut from the Federal Reserve has completely inverted. The market is now pricing in an emergency antibiotic for a sick economy, not a vitamin shot for a healthy one. And that changes where your money should and should not be. For those of you who are new to the channel, my name is DataCat. I used to be an analyst inside a big Fortune 50 company. I spent my days in spreadsheets and boardrooms, but I traded that corporate life for this. That being said, it's not like we are having a wonderful job market, do we? My goal here is simple, to give you the same kind of data-driven analysis I used to provide, without the corporate jargon and the sales pitch. This channel is only a few weeks old, so if you find this perspective valuable, maybe consider subscribing. It would mean a lot. Now, let's get into what just happened. Alright, so the story we were all being sold was that the jobs market was strong. As mentioned in my previous video, the headline numbers looked okay, and that gave the market cover to keep rallying. It was a classic good news is good news environment. Well, the July jobs report came out, and it wasn't just a miss. It was a complete demolition of that story. The economy added only 73,000 jobs. But that's not even the real story. The real story is that the numbers for May and June were revised down by a combined 258,000 jobs. That's 250,000 jobs that we thought existed. That just vanished from the data. The weakness isn't in the underbelly anymore. The weakness is the main story. You know, it's like when a cat very, very carefully walks across a mantelpiece pretending not to see the vase. The market was that cat, and the jobs report was the sudden loud noise that made it jump and send the vase shattering to the floor. The pretense is over. And the most bearish part? The unemployment rate only ticked up to 4.2% because hundreds of thousands of people just gave up and left the labor force entirely. They stopped looking for work. That confirms the weakness is profound. The bad news is good news narrative, where a weak report meant the Fed would cut rates and boost stocks, is dead. This is now a bad news is bad news world, where economic weakness is a direct threat to company earnings. This brings us to the second point, earnings. The entire bullish case, the one pillar holding up this whole market, was the AI-driven spending cycle. The idea was that this was so powerful, it could override any other macro concerns. That pillar is now under immense pressure. The AI narrative is still powerful, don't get me wrong, but it is not immune to a genuine economic downturn. The question has shifted. It's no longer, can AI spending power the market higher? The question is now, can AI spending prevent tech giants from lowering their future guidance because the rest of the economy is rapidly cooling off? Your portfolio's exposure to big tech is no longer a bet on explosive growth. It's now a bet that their balance sheets are strong enough to withstand the recessionary storm that seems to be brewing. We've gone from relying on this pillar for growth to just hoping it doesn't crack. This leads us back to the market psychology. For months, you heard about the theory about all the skepticism and the $7 trillion in cash sitting on the sidelines were actually bullish. It was fuel for the fire. As the market went up, these worried investors would be forced to jump in, pushing prices even higher. Well, that wall just crumbled. The jobs report validated all the worry. The VIX spiking to $20 isn't just a number. It's the sound of the market screaming that the fears were justified all along. So it's no longer a wall of worry that you can climb. It's a chasm of fear that everyone is now staring down into. And that $7 trillion in cash? It's not fuel anymore. It's emergency supplies. That money is now much more likely to stay safe in money market accounts than to be thrown into a market that suddenly looks terrifying. It's like a cat that was cautiously watching a toy mouse from across the room. That was the wall of worry. Now the toy mouse has suddenly turned into a vacuum cleaner. The cat isn't worried anymore. It's actively running in the other direction. the psychology has completely flipped from skepticism to active risk aversion. Oh, and just as the market was trying to process the jobs report, a second shockwave hit, an external structural shock. The announcement of potential universal tariffs of 10 to 15%. This attacks the market from a completely different angle. The jobs report signals internal cyclical weakness. The tariffs are an external structural shock. A universal tariff is a direct tax on nearly all imported goods. This isn't some subtle inflation that builds over time. It's an overnight price hike dictated by policy. This gives corporations a terrible choice. 1. They can absorb the cost, which will absolutely crush their profit margins. 2. They can pass the cost to you, the consumer, which will destroy demand that we now know is already weakening. It's like telling a cat it can have the tuna, but the can opener is now locked in a safe, and the combination is a calculus problem. Either way, dinner is going to be a problem. Both paths for corporations, absorbing or passing on costs, lead to lower earnings, which makes current stock valuations look incredibly unstable. This all leads to the absolute worst-case scenario for the Federal Reserve. This is the point I made at the beginning, and it's what Wall Street doesn't want retail investors to fully grasp. The weak jobs report demands they cut interest rates to support a collapsing labor market. The universal tariffs demand they hike interest rates to fight the massive wave of inflation that's about to hit. They are caught in an impossible bind. And this is why the reason for a rate cut matters so much. The old view was that the Fed would cut rates as a vitamin shot for an economy that was doing okay. This would have been bullish for a wide range of stocks. The new view, the one the market is now frantically pricing in, is a bearish cut. It's not a vitamin shot, it's an emergency antibiotic to stop the bleeding from a potential recession. The FedWatch tool showing an 83.4% chance of a cut isn't a sign of euphoria, it's a sign of panic. In this scenario, investors don't buy economically sensitive small-cap stocks, they flee them. They run to perceived safety, bonds, gold, and maybe the few mega-cap companies with fortress balance sheets. Alright, so where does that leave us? The idea of a blow-off top is off the table. The market is now in damage control mode. The question has shifted from how high can we go to how low do we go. And to answer that, you need to watch a few key things very closely. First, keep your eyes on the VIX. As long as it stays elevated, let's say above that $20 level, you should expect these wild 1 to 2% daily swings to be the new normal. Volatility is back. The second thing to watch is the 50-day moving average on the S&P 500, which you can track with the SPY ETF. As of now, that key level is right around $610. This isn't just a line on a chart, it's the first major battleground. A decisive break below it would signal that sellers are firmly in control, and we could be looking at a much deeper correction. Then, this is where you can also use something like the Fear and Greed Index. When you see that needle dip into extreme fear, it's not a signal to join the panic, it's a signal to pay attention. It tells you that indiscriminate selling is happening. A scared cat will hide under the bed during a storm. A smart cat waits, watches, and knows that maximum fear is often when the best opportunities start to appear for those with a plan. So, is there no saving the market from this correction? In the short term, probably not. The damage is done and the market needs to reprice for this new reality. But hope is a different story. Hope just has to change its definition. Hope is in the clarity that will eventually emerge from this chaos. Hope is in the generational opportunities that are created when panic makes people sell great companies at a discount. And hope is in the fact that strong, well-run companies will survive this and come out even more dominant on the other side. This is a time for defense, for patience, and for having the courage and capital to act when everyone else is panicking. That's the analysis for today. If this data-driven approach helps you make sense of these chaotic markets, I'd appreciate it if you'd subscribe and hit the notification bell. I'll be tracking these levels closely. Thanks for watching. DataCat out, stay sharp and stay safe out there.